Footprint course Unit 6, Absorption and Auctioning. This is challenge day 8 of 30. In the following slides we are going to focus on the art of consistency, why it is so vitally important, and how to gain increased consistency. The first and most important, action plan, or the step in the action plan is to understand the power of a consistent approach. Okay, now this is a bit like religion, right? Most people struggle with the concept of religion and the concept of faith simply because they kind of want to see a result almost. They want to see, if I was religious, what would all the great things be like? What would all these wonderful things, appear like? They want tangible almost. Okay, now. It's the same with the art of consistency, right? You have to believe in the actual process. You have to believe and understand that through a consistent approach, ultimately, you're going to get rewarded at the end. Okay, now, you would have only seen this if you've actually ever stuck to a consistent approach. And I'm going to share a really nice example with you tonight, something that I've gone through personally, and hopefully you can, not just sort of take away from it, but also apply this to your own situations. Okay, so the first thing to understanding the power of a consistent approach is to understand the definition of what consistency means. Okay, now obviously I've got the textbook definition here, but the only real sort of parts I actually like to this is I really like this, the lack of deviation and the lack of change. Okay, that is the key success and the key understanding behind consistency is there is no change. You have a plan, you stick to it, you go through it, doesn't matter high or low, it doesn't matter what happens along the way, you stick to it. Okay, and there's no deviation, there's no ifs and buts and changes. That is, if you can stick to those things, a lack of change and a lack of deviation, ultimately you're going to have achieved a consistent approach. Okay, so the second step in order, on the process to getting more consistent, right, is you need to set a big picture goal, right? Now, I'm not talking about, in 1 year's time, I want to be a millionaire, okay? It's a simple goal. And the example I'm going to use, when I move on to the next slide, as I'll show you here, is the goal of a half Ironman, okay? It's no secret, a lot of you that have been following me for a while, I'm training for a half Ironman, and I'm relating to this training I'm going through, to developing a consistent plan, okay? So, set the big picture goal. What is it ultimately? Where do you want to be 12 months from now? Where do you want to be a year from now? What is it that you're trying to achieve? Okay, make that goal nice and simple, nice and objective, nice and easy to understand. What is it? Okay, write it down on a big piece of paper and stick it up on the wall so you know where you're ultimately heading toward. Then, and this is where the key comes in, you need an exact action plan. Okay, now for me with regards to this half Ironman, it's pretty straightforward. I've got a training program. The training program's been developed for me. I simply follow it. I know exactly how long my program is. I know what time I'm committing to the program. I know the place and I know the activity. There's very little I can deviate from this plan. Why? Because it's an exact plan. Right? The plan is simply like following a recipe. It's a step-for-step process. Okay? You need to do the same thing in your trading. You have to set out an exact action plan. Now, that can be an action plan of routine. That can be an action plan of, just simply, being able to do a debrief at the end of every single session for 3 months. Okay? But set an exact action plan with the time, the place, and the activity. And don't allow for any deviations. Remember, the lack of change and the lack of deviation is what consistency is all about. Then, accountability. You need to determine and find some way to make yourself accountable to this exact action plan. Okay, now again, obviously in the example of the Ironman, I've got constant reminders. So every day I get this little buzzing in my email, my phone buzzes and it says, hey, you gotta go train now. Okay, there's no excuses. Now, there's a number of different things you can use. You can use things like alarms. You've got all sorts of apps nowadays, technology. You can have a partner, someone that you're accountable to. Okay, so like with training, like with trading, make yourself accountable in one way or another. Again, guys, what I'm trying to do is relate the two here. I want you to take each one of these, the accountability, the exact plan, the big picture, the understanding, and I want you to apply them to your individual situation. It doesn't matter if you're a trader, it doesn't matter if you're an accountant, it doesn't matter. The steps to become consistent are the same. Then, make sure that you set simple, small, achievable steps every single day. This is the number one, sort of step in the action plan that almost 90% of people fail, including myself. Okay, I've failed by, with action plans probably so many times in my life, I cannot begin to tell you. Right? It's only now that I've been on the other side, that I've seen, an approach that works, that I'm able to relate this to you. Okay, so make sure whatever process action plan you put in place, it is simple. Okay, it's not complicated. It's not, I'm going to do 3 things today and then 1 thing tomorrow, and then, I'll try something. Keep it simple. All right, keep it short every single day, 30 minutes, commit, make the commitment. Okay. And make sure they're achievable steps. Don't overcommit. Right? It's that overcommitment that when you fail to achieve, that you lose motivation, you drop off, and ultimately the action plan, falls away. Okay, so that's the next step. Don't overachieve. You don't want to be an overachiever. Consistency is not about overachievement. Okay, that's a fallacy that, again, you look at, for instance, these YouTube videos and, these sportsmen on the television, you think, wow, these guys are overachievers. I'm going to have to go out and overachieve now to become like them. No. Okay, they followed the exact same action plan that I'm showing you. All right, they started with simple, small, achievable steps. Over time, they were able to overachieve as a result of having an action plan toward consistency. All right. Don't overtrain. And again, this is related to training, but this is trading. You do not want to be sitting on a trading floor 14 hours a day. Right? You can only realistically be focused for 7-8 hours a day. Okay, realistically. So just accept that every day you can only do so much. Don't overachieve, don't overtrain, and never overcommit. Okay, don't come out saying, bang, 7 days a week, I'm going to focus on my trading, I'm going to spend an hour every single day, because ultimately it's not going to work in the long run. You need the balance, you need the ability to get away and experience and enjoy life, okay? Don't overachieve, don't overtrain, and don't overcommit. Then, create the feedback loop. This is so crucial. You need that feedback loop that's constantly coming to you saying, well done, excellent, you did this. Well done, excellent, you did this. Well done, excellent, you did this. You're progressing, you're progressing, you're progressing. You're achieving, you're achieving, you're achieving. Okay, you need that constant feedback loop that's giving you an overall summary of 1, where you started, 1, where you're headed, and how you're getting there, the steps you're taking. Right? It's that feedback loop that gives you the motivation. It's that feedback loop that's constantly telling you, what, actually, shit, I'm starting to feel a bit of consistency coming. I'm actually starting to feel good about this. Wow, I'm starting to feel strong. I'm starting to feel like this is really working. And that, when you start to feel that little bit of a positive feedback loop, that is what drives you to take it a step up and ultimately, get towards where you want to be. Then set the motivational cues. Now, so crucial along the way. There are going to be points in time where you just cannot be asked. You cannot be asked to be consistent anymore. Why? Because it's tiring. You're not seeing the big picture anymore. You're just not feeling it anymore. Right? So set the motivational cues, whether that's a motivational statement, why I started this in the first place, whether that's, writing about someone that matters to you. Set that motivational cue. Okay, you have to have some motivation for why you're doing what you want to do. Then another good one is obviously the before and the after. You see a lot of people doing this with regards to weight loss. Take that picture on day 1. Measure yourself on day 1. Make sure you know where you've come, because you never ever want to go back there again. Okay, that's what the motivational cue is about. It's so you can lean on it when things get tough. Then push the boundaries within each effort. Now, this is the beauty of this little simple step, okay? When you're doing simple, small, achievable steps every day, you start to get this little bit of a feeling, okay? And I felt this personally in my training. You get this feeling that actually, I'm not doing enough today, but actually you are doing enough. And the fact that you feel that you're not doing enough, all right, that's the time to take a step up and push as hard as you can within those small achievable steps that you're taking every day. Because it's when you step out of that boundary within each one of those efforts that you're experiencing real growth, but you're doing it within a smart action plan. Last one, don't change the game plan. Remember, it's the lack of deviation and the lack of change. Don't change the game plan just because it comes tough, just because suddenly, you know, there's a speed bump in the road, just because things become tough. Don't change the game plan. It doesn't matter if it's week 1, week 2, or week 13. Don't change the plan until you get to the end, because if you can survive and get to the end, you are going to finally, for the first time in your lives, experience consistency. Okay? See the forest amongst the trees. You know, every time you've had a bad day and you can't be asked to do that debrief, say to yourself, if I don't do this, where am I going? Well, I'm going back to square one. Make the commitment, small little steps, and you will ultimately start to develop consistency. Okay, consistency, I will tell you, not just in trading, but in life. Consistency is probably one of the characteristics or the skill sets that very few will ever experience and ever master. You want to be a successful trader, you have to have consistency. Okay. Now, before I move on to seeing this slide, I'd like to welcome you to the practical part of the course. This is all going to be based on the strategies over the next 10 units. So every single one of the next 10 units is going to follow a very simple process. Each one of the strategy unit sessions will begin like this one began, outlining a very key principle within the trading, and ultimately we'll do that in a mentor type fashion. Once we've done that, a very, very key relevant quote. You will see me utilize this quote throughout the unit and why it's so applicable. And then we're going to move on to the real practical application. We'll really construct the trade strategy utilizing the blackboard. We'll break it down into the various variations you can expect to see, the execution methodology, and a whole bunch of tips, etc., etc. And obviously the live examples with a cross-pollination of not just the footprint, but also the candlesticks as well as the price ladder. That is to ensure, obviously, a lot of the strategies you might already recognize. So just to ensure a real ease of overlap between the different tools, I have included all three tools in the same live examples. Each unit session will then end with an additional reading over the next 10 units. I'm going to provide you with what I think are probably 10 of the most important trading books out there. You will note that none of them are actually trading based. Most of them are psychology or thought-provoking based. And then we'll finish off each one of the units with your drill-based session. Okay, so let's get into it now. As you can see, that this strategy we're going to focus on the absorption and auctioning. First and foremost, it is a momentum strategy. Okay, so I've broken up the two columns into momentum and counter trend. Obviously, some of you prefer momentum strategies, some of you prefer counter trend. Now, what you are going to find is that some of the strategies might not suit your style, and that's fine. But as you'll see, as we go through every one of the strategies, you're going to recognize that knowing these strategies doesn't mean you necessarily have a strategy at hand, but it could assist you in many other ways, i.e. targets, i.e. taking profits, i.e. where to place stops, etc., etc. So knowing these strategies, knowing these principles will aid you, in making, obviously, trading decisions. Now, this is a momentum-based strategy. It is standalone, so you don't require any other trading tool to recognize this trade strategy. And obviously, in terms of execution, it's a passive execution. You're going to wait for the market to come back and allow you a relatively straightforward entry point. All right, let's now move on. In the next couple of slides, we're obviously going to start off and we're going to focus on the principles underlying the strategy of absorption and auctioning. Now, as we focused on in Unit 3, we went through all the various principles that you can expect to see in all the strategies. Now, on this slide, what you can see is two sections, Part A and Part B, and those effectively come from Unit 3. But what I've done is I've annotated stars next to the principles you're going to encounter in this strategy. So you're almost expected to understand these principles in order to effectively apply the strategy. Now, not to worry, because when we go on to the next slide, I'm going to introduce you to the blackboard as well as the practical examples, and you're then going to see me apply every one of these principles with an example. So you'll see me illustrate it, you'll see me utilize the principles, and hopefully you'll begin to understand what each one of these principles means and ultimately how it adds value to the trade strategy.
Okay, now before we move on to the next slide, do bear in mind the next couple of slides. I'm going to begin on the blackboard. I'm going to show you the strategy. I'm going to annotate it, show you the variations, show you the principles that underline the strategy, and then I'm going to move on to practical examples with a static example of the footprint, before then finishing with live practical examples of the footprint. Now do bear in mind, this will be an entire video session where I'm going to point it out for you. If, however, there was something you wanted to go back and view, or you maybe wanted to watch the full length of the video, do note in the next couple of slides you will be able to view all of those charts at your own time, as well as the full length video of the practical example. All right, let's get into it then.
Okay, so what we're going to do over the next couple of slides now is we're going to actually introduce the trade strategy of absorption and auctioning, and we're going to take a look at real practical application of the strategy through means of firstly drawing the strategy and showing you where the various principles fit into the strategy, before then turning our attention to the practical examples, which will include both static examples as well as live examples. Now, to illustrate this strategy is very simple. It's like we mentioned, in the principle section. In effect, what we're seeing is the process of accumulation and distribution within a confined number of prices. Okay, so we can think of it, and I don't want to get stuck in the principal idea of support and resistance. So I'm rather going to call this just a pivot and a pivot. Okay, so in essence, the market begins the process of trading between two pivots. Now, one of the key principles we focused on was the principle of consolidation. Now, most important, note, this is not consolidation. Why? Because consolidation, as we mentioned in the principle section, tends to be relatively low volume. Okay, so what we're actually going to be talking about is the process of accumulation and distribution. Okay, now we noted the key difference between accumulation and distribution and consolidation was very simply the volume and the delta exchange. In other words, in accumulation and distribution, we do tend to see a much higher relative amount of volume being traded versus the consolidation. Now, the key identifier of this trade strategy comes at the extreme pivots. Okay, and what you're going to tend to see is you're going to tend to see some real dark, high volume areas, and then effectively some real dark, high volume areas and high volume areas. So you're going to see this process of high volume areas at the extreme points of the pivot. Now, note, obviously, in terms of the auction process, what we're seeing here is no real strength in the auction process, rather just responsive price action at the high and then responsive price action at the low. Okay, once it finally breaks in either direction, we then get the process of initiative. Now note, obviously, when we do get this initiative response and this stronger auctioning process, it's usually going to be accompanied by some auction imbalances. Okay, so very typically, once the break comes, obviously you're going to get these auction imbalances accompanying it, and the reason being is very simple. If we look at what's effectively happened with the delta and the volume whilst we are sitting inside this accumulation and distribution zone, in essence what we're doing is we're building up a position within this tight range. So within this range, we're either going to have a positive or negative position. Now, what I will say, I've never found there to be a good rule of thumb that if the delta is more negative or more positive, that has a high probability, sort of in terms of giving an indication as to which way we're going to break. But what I would say is that high volume and that high delta, in essence, implies that when we break, there are positions caught on the other side. So, for example, if it breaks to the downside, obviously we do have some longs that are caught. Okay, so those longs need to pay down very quickly, and it's that reason that we get the high volume, the high delta, as well as the
auction imbalances. Now, in terms of the relative change, obviously you will note a distinct difference between the volume, the delta, and the cumulative delta in the zone relative to once it breaks. Okay, once it breaks, you are going to see a real shift in the volume, price, and delta dynamics. Now note, obviously, you will see much lower relative volume within the zone compared to the break, and that's obviously simply because of the initiative being taken, as well as, obviously, again, I don't want to really use the word support and resistance, but you can think of these pivots in terms of some form of maybe the lower pivot is some sort of a initial support, whereas the higher pivot is some sort of initial resistance. Now, do note, obviously, one of the key things to consider as well is liquidity. Whilst we are inside of this range between the two pivots, there is actually quite a high amount of liquidity being provided. Why? Because we can see that there's some real aggressive accumulation taking place on both extremes. Okay, so there is high liquidity, which sometimes means that the break isn't always as clean and directional as you want it to be. Why? Because if someone's providing liquidity over here, okay, they could be providing liquidity even higher up, and that's why we sometimes actually do get failure of the absorption and auctioning strategy, which I'll talk about in a minute. So that's the basic principles applied to the absorption and auctioning strategy. Now, let's go and have a look at some of the practical examples that you can expect to see. In fact, before we move on to the practical examples, let me just show you the three variations that you can expect to see within the absorption and auctioning. Now, the first is obviously, as I showed you, and I'm going to draw these very briefly, so do make a note in your notebook. So the first is obviously where we have a very clear pivots. Again, these lows are not going to be exact every time. They could extend by a tick or not, but in essence you want to see the high volumes at the extremes. Then the second type of variation, which a lot more of you will be familiar with, is more of an inside candle approach, where in effect what happens is the market it finds some sort of accumulation and distribution in a tighter and tighter range. Okay, so failing to take out either the previous high or the previous low as the next candlesticks come in. Now note, obviously, you'll see this a lot easier on a time-based rotation, but that's the second type of variation of absorption and auctioning. And the third type is in essence where we've got a failed sort of break of the absorption and auctioning. So in essence what happens is the market breaks to the one way or to the other way and comes back in. Okay, so in essence, in these two examples, we break and initiate in one direction. In the third example, we break, try to initiate in one direction, and very swiftly reverse. Okay, those are the three variations we're going to discuss as we go through the rest of this unit. Now note, where does this strategy best come into play? Now, this is important. What we're going to talk about when we get to observing a strategy is that in essence you can see this in both balanced and imbalanced markets. But what I would say is this concept or this trade strategy of absorption and auctioning is going to occur best in imbalanced conditions. And the reason is very simple. Okay, like I said, remember what we're looking for is we're looking for initiative once we break out of the key pivot area. Now, if the market is in the imbalanced zone, okay, note that imbalance just simply means we're trading maybe quite close to the extreme of the previous day, or even sometimes outside of the previous day's range. Okay, so if we're seeing the concept of absorption and auctioning occurring in an imbalanced area of the market or market context, this means that this initiative has the potential to be far more aggressive. Why? Because if we're trading quite close to a previous day's extreme, we know that the potential for a breakout is quite high. So we want to utilize this absorption and auctioning to play for the potential breakout of the previous day's extreme. Okay, so that's obviously in terms of market context. Do note, however, you can see this in balanced conditions as well. It's not to say it doesn't work equally well, but for me, I've noticed that in imbalanced conditions, the absorption and auctioning trade strategy works far more effectively. Okay, let's have a look at some examples now. So obviously this is taken from the 16th of December. It's the euro dollar. Do note this is a rotational based candle or footprint chart. Now, as we go through every example, I'm going to show you, both time-based and rotational-based, so that you get used to, seeing them with different views. Now, obviously, what we can see is the absorption and auctioning. It can work particularly well on a rotation, assuming that your rotations are set to the right rotation. Okay, so what we can see is that the market entered in from sort of 6:05 a.m. in the morning not 6:05, sorry, that'll be in the evening. In fact, I don't even know what these times mean, but this is definitely not the morning session. Okay, obviously, as we go through these strategies, guys, none of these will be taken outside of cash hours for good reason. Like I mentioned, most of the strategies are applicable when there is interaction between buyers and sellers. Now, we noted that interaction is best seen when the cash market is in. Okay, so these time formats won't be quite correct, but in essence, what we've seen is the market has gone into a sideways holding. We can obviously see a nice pivot on the downside and a nice pivot to the upside. Now note, we can see some real extreme absorption at the high, and then again equally some absorption at the low, some absorption at the low. Once that resolves itself, again note as well, whilst we're in this zone of accumulation and distribution, note the high volume, okay, relatively high compared to what we've seen. Also note the delta. So note how the delta goes positive on the upward rotation, and then high volume, and the delta goes negative on the downward rotation. Okay, and this is a function of absorption and auctioning. You are going to see this within these rotations, but the important thing to note is once we break, we want to see initiative. Now note initiative in terms of the delta. And the colors you can expect to see is that you're going to get the initiative. The initial part will be light colors. Okay, so as you can see here, we can see relatively lighter colors here and relatively light colors before then running into darker colors once we start to see liquidity being found. Okay, just that's what you can think of the darker colors as. It's simply just liquidity being provided. So once we get the initiative, it will look like a lighter color until it runs into some responsive sellers in this example, which will start to make the delta colors a little bit darker. Okay, do note obviously, well, like we said, we want to also see with any kind of initiative, we always want to see the volume pick up, but we also want to see the delta go in the direction. That's so crucial with initiative price action. You always want to see both the volume and the delta go in the direction of the initiative. Now note in terms of color lines, like we always say, once we get that initiative being taken, we will obviously post a nice turquoise color. Okay, so in terms of entry point now, what I am going to say is do note, I think one of the mistakes that a lot of traders will make with any strategy is they want an exact execution. They want an exact entry, an exact exit. Okay, it doesn't work like that. All right, the important thing to understand is that every one of these is a strategy, but in essence, what we're looking for is we're looking to be long once the market, retests or shows us some form of absorption. Now, if I can remove this here, you'll see quite a lot of absorption taking place in the zone, around these 75 to 77 area. Some real good absorption. That's your entry point on the break. Why? Because what happens is we initially see some responsive buying here and responsive selling, and what happens is that responsive selling or that pivot resistance then becomes pivot support. Okay, now note the two variations with regard to the break up or down. Like I said, you can see some very aggressive initiative where we do tend to have imbalances. Or, as in this example, you can see that we have a relatively slow, gradual move to the upside. Okay, now that's important to note because, it's not always going to be as straightforward and clean as, some of the examples you might see in some of the later slides. Now, the next example again is one of the failed reversals now, and I'm going to show you this failed reversal and show you what it looks like. So again, this is taken from the E-mini S&P 500, quite recent as well. Now again, what I want to show you is this market enters a phase of consolidation. We can see real sort of extreme kind of volume, negative delta taking place. We then see a flip of that. The market then absorbs on the higher up prices, and then it initiates. And this is quite interesting because we then get the initiative taken to the upside, and we notice that because of the volume as well. So the market initiates to the upside. We see, obviously before that, we did see quite an aggressive amount of responsive selling in the market. It got overwhelmed, the market extends to the upside, but very quickly reverses and finds itself back inside the initial range. What then occurs, the market retests, note, and this is the key to the reversal strategy, the market then retests that original absorption area before we broke. Okay, so that's what we call a high pocket volume, or a high volume area. That was where the passive selling was occurring. So the market re-enters that zone, it retests and again absorbs another 1600 contracts before then beginning the aggressive reversal. Okay, so like I said, the reversal trade strategy, what tends to occur is once we fail to break, we then re-enter range, but we very quickly move from one side of the range to the other side of the range. And what you can see is that market within the same rotation takes, almost within a couple of minutes, reverses straight to the other side. So that's a key factor of the reversal strategy. So again, if you're going to learn the strategy, remember first and foremost, we're looking for the break. Obviously, you need to manage your stop quite effectively. As I said in the previous example, if we go back to that quickly, very simply, we ideally, we don't really want to see, we can see the market gave us a nice imbalance, but ideally, we don't want to see the market re-enter this range. So again, in terms of a stop, if you're someone that keeps it very, very tight, you might have had only a couple of tick stop. For me, I didn't want to see this imbalance be taken out. Why? Because the imbalance shows that the start of initiative. So for me, a stop would have gone right over there. Notice it did come and try and test it before then reversing in the other direction. Okay, in terms of target, this is always a tricky one for the strategy. What I always say is you get out when the market tells you to get out in the strategy. So simply put, we can see obviously the market began a process of absorption here. It had a little inside candle and then extended again. So again, the market didn't really give us any reason to get out. Why? Because it didn't really take out any previous swing lows. I would have said once we saw this double bottom, I would have become far more cautious. Okay, in terms of obviously the rejection strategy, well again, target is a little bit of a nuanced fine art, but again, what we're looking for is a flush in the opposite direction and let the market tell us when it's time to get out. Okay, our last example, again, another one of the rejection ones, and again, I want to illustrate this twice just to show you how common they are. So obviously, as we can see, the market again settled into a sideways range, but one thing you should note here, and this is where I caution you on the strategy. Remember what we said, the difference between consolidation and accumulation and distribution is the volume being traded. Okay, now note the volume being traded here. Do we have extreme delta on the extremes? Okay, and the simple answer is no. Okay, this happens to be the euro dollar again, but no real extreme. A little bit of extreme printing coming in there and there, but not the best example. I wouldn't have been looking at this going, okay, this is a potential opportunity, and we can see that also simply by the delta. Okay, this is always the dead giveaway clue. There's no shift in that delta on either side, and that tells me this isn't a process of accumulation distribution, but rather a process of consolidation. Now, the reason I wanted to include this was very simple. Okay, a lot of you will look at that and say, well, it's a perfect example. It broke, extended, left all sorts of imbalances, had a high volume and a shift in the delta. So in essence, it still did the same thing. However, remember, this job's about reducing, or increasing the probability of success, and that's why the conditioning is crucial. Okay, so note, it's only absorption and auctioning if we have got high deltas at the extremes, which we can see with the delta in the example provided. Okay, so that's our three examples. Let's now have a look at one of the trade strategies, and what you'll note obviously is that with regards to the trade strategies. I'm going to play you through it, and I'm going to identify a few things for you. Don't worry if I rush through this, guys. You will get plenty of opportunity, to go and run this on your own and watch it back in your own time. Okay. Alright, let's just give me one moment, just trying to get this playing. Okay, apologies for that. Now the first thing, before we actually move into the example that you can see in front of you, is just a little tip with regards to the trade strategy. Now, I'm going to give you these tips alongside all the rules of thumb, but the tip for this trade strategy is there always tends to be calm before the storm. Okay, so you tend to see this real just slow moving market, almost like a breath. Something triggers, maybe it's absorption on the one extreme, but there's always this little bit of relative calm, and then suddenly the initiative is taken. So that's what you're looking for in this trade strategy. You're looking for anything that hints at the potential for initiative to be taken. Now, the example in front of you is the euro dollar from the 18th, and I'm just going to run this through. Obviously, bear in mind these examples. The full example will be there for you to watch the entire video. Obviously, I'm going to be running through it relatively quickly, showing you the key points, showing you the tips, and hopefully you get an idea. So I'm just going to fast forward this fractionally, show you when we get to that phase of sideways. Now, to bring things into context, and this is why we have the candlestick on the right. Note we are in a little bit of a drive up this morning. We are imbalanced at the moment. So this is what I said. This is ideally where the trade strategy works very well, is when we get this accumulation distribution at an extreme point. Now, the first thing to note, obviously, note the delta at the low. Then equally note the delta at the high. So we're seeing both absorption at the low as well as absorption and response at the high. And this process continues to occur for some time now. I'm going to show it to you. I'm going to keep fast forwarding it, and then I'm going to show you a little bit of a tip. So again, notice again the responsive buying coming in. Notice the delta. This is what I said. You're always going to get positive delta, negative delta. So wherever that response comes in at whichever extreme, you're going to see it in the delta. Now note, obviously, we're looking for any signal of the potential for some form of initiative to be taken. So again, note what we see at the high. Okay, some real positive, buying and intent, but someone is still happy to take that liquidity. Okay, and this process goes on for some time. Now note, what we suddenly see, if you were to compare every one of these last auctions, notice what we've just seen in this latest auction. If you were to just visually eyeball this, something looks uniquely different about this auction. Okay, one, notice obviously where that last 173 lot got reloaded. Notice how we only traded 13 lots before we sold off, and look at the volume traded in this rotation compared to all 5 of the previous rotations. Okay, you'll very distinctly see nothing really got traded yet, and that was the clue. That was the calm before the storm. Now, let's see what the storm looks like. I'm just going to get to the point of it so I can show it to you again. Okay, what we can see, a little bit of buying coming in, and now let's see what this initiative looks like. So note here, 39 contracts traded where we last absorbed, 21 contracts traded. So you can see there's really nothing going on. From going, from a point where every time in extreme there was a great deal of absorption to suddenly very, very calm, sitting on the highest price of the day. That's the calm I'm talking about. Okay, and that's the calm that you ultimately want to take advantage of. Now, there's one more little clue that did come in here. Ultimately, I'm going to just illustrate this if I go a little bit further forward. So again, we can see obviously the market did back off there. Okay, we came all the way back again, responsive price action at the low. And let's see again, we're going to get another little clue. Again, notice the responsive at the low, delta negative, delta negative. Okay, and let's see what happens. So again, similarly to what we saw when I pointed out this very, very interesting rotation, notice what we saw here again. So the market came down. We traded 400 contracts in total, some real responsive buyers sitting there, and then the market left a really, really low volume area. Okay, and this is often what happens just before we get a breakout of this accumulation distribution. We either get what we call an auction imbalance, which you know about, or we get this low volume area. And straight away, note the zeros. That's obviously the beginning process of the initiative taken. Okay, so in terms of execution, if I just go back fractionally, once we saw that little bit of, we saw obviously the little bit of imbalance taking place, you'll notice that 115 contracts got traded. Let's see what that looks like, because that was ultimately our opportunity for some aggressive execution. Okay, obviously, what I would say, when we go through the slides, we talk about the execution side. You don't have to preempt any of these trade strategies. Okay, as you get better at them, you'll learn to preempt them because you'll learn the nuances of it. But what you can see is you could have actually preempted this just simply because of the reloading taking at the high. Now notice every time that we've ultimately been at the extreme, we've had sellers or we've had a buyer buying into some really aggressive sell side response. This time, however, we have a seller selling into a really aggressive buyer. In other words, we've got a really aggressive buyer reloading at very extreme prices. And that was our clue. That was our subtle clue, a lot like the clue we saw in the previous rotation. Okay, as a result, once the sellers recognize that buyer, we begin the process of auctioning aggressively higher. Okay, and this process continues. You can see obviously we make an extended high, a little bit of imbalance as we mentioned. Market finds a little bit of sell side, comes back. Notice what it retests. Okay, it retests that breakpoint before then extending on higher. And I'm just going to fast forward this so we can see the process of one time framing. So note, obviously we got the break. Note the market did come back a second time, give you an entry point before then continuing higher. Okay, obviously you've got this video to go over yourself in your own time, but I just wanted to highlight that really key, nuance shift in the price action. That's what you're after. If you want to get good at the strategy, you're going to need to learn to identify that little nuance, because that's going to give you the perfect timing on the trade strategy. Okay, now let's look at another example, this time in the gold market, and this time we're going to have a look at what an aggressive reversal looks like. So this was taken from the 6th of December. It is the gold market, and again, I just want to move this a little bit forward. Let's get to some of the key areas. Now, obviously, what you're going to see here is a process of accumulation and distribution. How do we know? We'll look at the extremes. We have a high delta. Look at the extremes. We have a negative delta. Okay, we have some really dark colors at the extreme sides of both pivots. Now, what I want to point out is once this market, retraces back in to the distribution zone, what then finally occurs. Now, again, you can see we've come down now. The market's beginning the process of accumulation and distribution. So we can see accumulation at the low, and then we distribute at the high, and then accumulation from the sellers, and then we distribute lower. And this process continues for some time. Now, what you'll recognize is that obviously we can see quite a negative cumulative delta on the day, but we can see again, every time the prices come down, we see the delta becoming more negative as the responsive buyers are happy to be filled there and provide liquidity. Equally, once we go bid, we can see obviously the responsive sellers happy to provide liquidity and get filled. Now, let's move on to the breakpoint, because remember, as I said, in terms of variations, you always assume that the break will continue with initiative. Okay, you never assume it will reverse. So I'm going to show you exactly how you execute the reversal now. Okay, so we can see again more negative delta, and let's see if we can find that little bit of a telltale sign. As I said, the calm before the storm. Now note. Okay, we can see obviously the market thinning out a little bit. Notice now in terms of, look at the accumulation that we were receiving at this price 66.1. So we're receiving dark colors here once and twice, and all of a sudden the market's beginning to happily facilitate trade again in this area. Okay, so what we can see again, and this is such a telltale sign, notice how previously we would see buyers absorbing the market and buyers reloading and providing liquidity. Now, however, look what the sellers are doing. Okay, look where the sellers are providing liquidity and where they're absorbing. So this was very, very similar to the previous example. You tend to get this just before the breakout. And there's your clue, there's your tip. When you get the absorption coming in from the sellers at lower down prices, that's your clue we're about to break. Now let's see what this break looks like, and let's follow it on the reversal. Now remember what I said in terms of breakout. We obviously we want to see some initiative, and we want to see some imbalances. So what we can see here is we broke below. Okay, we've seen the seller's position for the break. We've broken below, and what have we seen straight below that? Okay, some really, really aggressive buying. Okay, that was effectively our real big clue of the reversal. Obviously, okay, this is a little bit more of a tricky example because it didn't quite extend, as we can see on the candlestick. It didn't quite extend by that far. But we can see once, obviously, it did go bid, and that initiative came in. Notice the imbalances, notice the zeros, more imbalances, runs into a bit of liquidity. And what we're looking for now, if we're not already long, we're looking for potentially a long just in front of that imbalance. Okay, and you'll see, obviously, market does post a nice little engulfing candle, and ultimately comes back. Notice the fill there, if we just showed you in terms of the strategy execution, comes back all the way down to that previous high pivot, as we mentioned, gives us the opportunity to enter on a reload before ultimately continuing higher. Okay, so those are two strategies, guys. The one obviously initiates and continues. The other is failure, reverses very aggressively and initiates in the opposite direction. Okay, let's go back to the slides now, and together we're going to complete the template. Right guys, so this is obviously the first then of our templates that we're going to complete now that we've done the first of our 10 strategies. Now before I go through the template, I just want to go through a number of kind of rules of the template so you get a better understanding of some of the things I've maybe written in the template, but also some of the expectations of you when completing the template. Now, first and foremost, most important imperative, there is no right or wrong. Okay, there's no need for me to check your answers because there is no right and wrong. There's simply just pieces of information that you are going to extract. And I'll explain how that works briefly in a minute. Now, be flexible. Okay, this template's obviously been created for you. You can draw all over it. You can edit it, adjust it. Be flexible. Okay, it's there for you. Don't be afraid to change the titles. Don't be afraid to add in titles. You'll see there is provided 2 additional spaces to add in things. You'll notice I added in, for instance, in one section, some of the variations. In another section, I added in, the tip for every strategy. So again, utilize that space however you feel is most beneficial. Now, what I would say as we go through particularly the rest of the strategies, my advice would be, as we're going through, I mean, this is going to be the first one we're going to do together, but as we go through the remainder of the 9 strategies, print off one of the templates, and as I'm going through it, or maybe I get to the end of the strategy session within each one of the units, maybe just go and, maybe complete that template, make notes on that template, so that you're kind of jotting down all the vital pieces of information with regards to each one of the strategies. Now, most important, you will need to complete one of these templates every time you encounter one of the 10 strategies. Okay, it doesn't matter which variation of the strategy. If it's one of the strategies, complete the template. Draw pictures. Okay, you will see there is a space provided for pictures. Draw those pictures, illustrate them. Use colors, guys. Use colors. Like you noted, I always drew absorption, with a dark color. Okay, you're going to see me utilize that throughout the next, 9 sessions. Now, note, make these sorts of, graphic depictions for yourself. Again, this is ultimately a template built for you in mind. Okay, now, the last thing is how. How do you actually complete this template? Well, it's very simple, okay? You must think of the template as a stencil. So you get to the end of the day, you've observed potentially 2 or 3 of the 10 strategies in maybe one market or a couple of markets. You then go back when the market's done, no risk on the table, nothing other than time to do your debriefing. And you go and apply the stencil to the market. So you start off with, like you can see in front of you, they observe the pattern, and you go and observe on strategy 1 that I observed in the oil market. What was it doing? Was it trending or consolidating? Okay, so the template acts as a stencil, and you go and then view in the market what was the fact-based information based on the strategy I'm observing. Okay, now you go through each one of these sections and you draw upon the information that's come from the strategy you've observed. Right, because what's going to happen now in time is that as you begin to observe this same strategy time and time and time again, you're going to notice that the characteristics I've outlined for you are going to keep repeating themselves. Right? Yes, occasionally they are going to be slightly varied, and that's the important nuances to learning these strategies. Because when it varies, the outcome is going to vary as well, and that is the real skill that you're going to develop completing these templates. Okay, now what we're going to do, let's start off with obviously observing the pattern. So again, note the 2 subsections to observing the pattern. First is market context and market conditioning. And when we start off with market context, we talk about whether the market's trending or consolidating. Now, do bear in mind, we spoke about the concept of consolidation versus absorption and auctioning. We spoke about the key difference being the relative volume. Now, note, we also spoke about dark shades with regards to absorption and auctioning, as well as the potential for extension. So obviously, the strategy of absorption and auctioning, we do want to see those dark colors, and we do want to see not necessarily trending, but definitely not consolidation. We want to see some sort of absorption type auctioning price response. Now, in terms of the balanced imbalanced markets, again, what we want to see is we can see the strategy in both. However, we note that it will likely be more aggressive in imbalanced markets. Now, What you would typically do here is you would get your strategy, whether it was, you'd get the absorption auctioning strategy, and you would determine, was it in a balanced situation or was it in an imbalanced situation? And you will then go and fill it out accordingly. Okay, now obviously in terms of trade location, in terms of market context, we do tend to see the strategy work better at extremes. Okay, why? Because obviously at the extremes, once we get that break, just after the absorption at the extreme, once we get that break, we do tend to get follow through as liquidity becomes slightly less on the breakout of previous days' highs and lows. Okay, obviously do bear in mind we do get the absorption auctioning occurring mid-range sometimes. However, by the very nature of it being mid-ranged, the market tends to be quite well balanced. Therefore, it's imperative to note the volumes trading through, as you could well be observing a consolidation period rather than absorption and auctioning. So just bear that in mind. Now, all right, then in terms of market conditioning, obviously we've got our various time frame participants. This is where you'll refer to which time frame participants were in the market. Note we do have the three, obviously we've summarized it in 3 time frame participants: large influential time frame participants, as well as algorithmic and speculative in nature. The major difference: large influential can obviously influence price, create initiative, and hold directional moves, whereas speculative and algorithmic, by the given the rules that they do trade by and obviously the strategies they employ, ultimately they tend to not hold on to positions as long, and they're far quicker to unwind those positions as well. So do just always make sure you're referencing which time frame participants are ultimately creating the market condition. In terms of liquidity, note we spoke about the different types of liquidities within both the accumulation and distribution zone. Obviously within the accumulation zone, you're going to see large pockets of liquidity at the extremes, large selling being absorbed at the lows, large buying being absorbed at the highs, and then ultimately the absorption just before the break. And obviously note, once we do get the break, the liquidity or the nature of the liquidity does shift from being provided at the extremes within the auction zone to suddenly then kind of disappearing, and the market looking to navigate toward the next pocket of liquidity. Okay, lastly then, obviously in terms of market conditioning, is volatility. And again, do note we spoke in terms of volatility. We said volatility does not equal trend. Volatility is simply a greater variance around the mean, so a greater number of prices being traded over in the same time period. And obviously we said that volatility will be relatively low within between the 2 pivots. Once we break out of those pivots, we should see volatility expansion. Okay, so that's how you would look at observing the pattern. You would go through each one of the market context as well as market conditioning, look at the market, draw the facts from the market, and apply yourself accordingly. Okay, good luck. Let's move on to the next session then of the template. All right, now the second part then of the template is all about strategy identification. So in the first, obviously, part of the template, or the beginning process of our template, we draw the picture, we select our strategy, and we observe the conditioning in which we find that strategy. Okay, so we create the market context. Now, what you're going to see as we go through a lot of these strategies is that market context is imperative a lot of the time to the potential reward. You're going to see me refer quite often to having, very, very rarely are any of these strategies going to have an exact target. Okay, trading is not that straightforward, right? We're not algorithms, we're discretionary traders. So a lot of the time our targets are based upon whatever context the market's in. So what I mean by that, for example, let's say obviously markets are trending and we're playing a breakout trade. Now, the potential for reward in a trending market where it's breaking out is much higher than, say, a market that's very well balanced, that's simply just moving sideways. Okay, so a breakout in a balanced market versus a breakout in a market that's trending, you're going to get very different outcomes, and your reward structures are going to be very different. Okay, and that's why we do paint initially the picture of what is the market context. Okay, so you can develop an understanding of what is the best context in which the strategies are working for you. Now, once we've obviously identified that context, we're going to move on to obviously identifying, the strategy. So what are the key observations that say to us, bang, that strategy is in play? All right. What was it that you could outline and draw from the market that said this strategy was in play at this point in time? Okay. Now, you're going to hear me talk quite a lot throughout the next couple of strategies over the next couple of slides. You're going to hear me talk, the next couple of strategies over the next couple of units. You're going to hear me talk a lot about clues and what is the timing clue and what was the signal that bang, there was your opportunity to get in with limited risk and maximum reward. And that's pretty much what you want to be identifying here. Is what are those identifications that you can draw that make the strategy in play? Okay, so the first obviously we talk about is the interaction. Okay, obviously remember the footprint tool is nothing other than an interaction tool. How are the buyers and sellers interacting? And that's what you want to talk about here. Now, what you'll find is with a lot of the answers I've given, particularly as we go through this over the next 10 units, I'm not going to regurgitate and just keep waffling on, etc., etc., because I want you to learn to think for yourself. I'm going to kind of just show you how to do it and give you little ideas of what you want to be thinking and talking about. But ultimately, through practice, you're going to get very good at completing these templates. Now, obviously, in terms of interaction, we first want to think in terms of responsive and initiative. So we spoke a lot about this principle in Unit 3. We touched upon it again in this unit session, and we're going to touch upon this for the next 9 unit sessions. So do note, obviously, whilst we're inside those 2 pivots, we noted the responsive behavior. So we saw the dark, sort of delta patches at the extremes of the pivot. That was ultimately the responsive, price response. And then once we get the break out of those pivots, that is the initiative break. Okay, then obviously in terms of, is the interaction passive or aggressive? Well, again, note, it's initially quite passive. Why? Because market rotates between the 2 pivots and there's just passive interaction taking place. Eventually, that shifts on the break and it turns to a more aggressive price response. Now in the box below, obviously, if there's any kind of variations you want to talk about, any kind of, any kind of, key points that really reflected time to enter, etc., that's where you want to include it. So in this box, what I would like to include, and what I want you guys to think about is, what was the key observation you took away in terms of interaction that gave you the clue that the break was coming? Okay, now we spoke about absorption just before the break. So for instance, obviously to the break to the upside, we spoke about how before the break we were seeing large selling absorption at the high and large buying absorption at the low. Just before the breakout of the high, we suddenly saw, instead of seeing large selling absorption, we actually saw large buying absorption at the high. And that's what you want to write in that box. What was the interaction that gave you that clue? Okay, because again, by writing this down every single time, you're going to learn to develop pattern recognition ultimately. Okay, now metrics, super important. You want to pay attention to these key metrics. Again, you simply get the chart up, go and have a look at the volume, look at the time, look at the delta, the cumulative delta, and the relative change. Make sure you're writing down what was happening with every one of these metrics within this strategy. Okay, so in general, what we observed was high volume within the distribution, but much higher on the break. For obvious reason, initiative does tend to bring new business and high volume. In terms of time, it is a relatively key proponent. Okay, and obviously this depends quite a lot on context. So in an imbalanced market, obviously, when we do get that break, if it's a break of an extreme or maybe the morning session high or low, obviously, we want to see that market continue in the direction of that break. And obviously, the longer the market takes to continue in that direction, the more vulnerable it becomes to the opposite direction. Then in terms of delta, obviously you want to talk about what was the delta shading looking like. So go and observe all the dark circles, go and observe all the imbalances, go and observe all the light circles, observe the color shading. Okay, if you do this, I know now it probably seems a little bit difficult, a little bit cumbersome, a little bit like I'm not quite sure what I'm interpreting, but I guarantee you do this for 2-3 weeks and you're really going to start to recognize patterns, where dark shading should be and where it shouldn't be. Okay, obviously then, in terms of the cumulative delta, note we should see no real change to the cumulative delta within the 2 pivots or between the 2 pivots. But once we break, we do want to see that delta move in the direction of the break. And lastly then, we want to talk a little bit about the relative shifts, the relative changes, whether that's to price, volume, delta, any kind of, the color changes, whether it's in the summary box at the bottom of the footprint or whether it's on the footprint itself. You want to go and highlight any kind of relative changes that occurred whilst you're observing the strategy. Okay, so that's how you'd identify the pattern. Again, like I said, when we completed the first part of the template, once you complete this part, straight away, after doing this for a week, again, like I said, you've got to have faith that this is a really strong approach, because what you're going to notice after a week is you're going to start to identify strategies, not so much with the picture necessarily, but how they should move. In other words, how should the buyers and sellers interact based on my analysis? How should the metrics interact based on my analysis? Now, what makes this, so brilliant is that you're observing fact-based information. So you're taking the facts from the market to develop your patterns. Now, when those facts repeat themselves, guess what? The pattern's going to repeat itself. And that's what we're after. We're after an objective, fact-based approach to trading strategies. Okay, let's now move then on to the last part of the template, which is the execution methodology. Now this is probably, again, I know all three parts are extremely crucial, okay, but this is probably the part of everyone's template or debrief that gets the least attention. It's quite surprising, because you'd think people would spend the most amount of time, managing through their execution methodology. Now, the reason most people don't spend time is because we kind of just assume that we're always executing in the best way possible, right? Now, I'll tell you why we're never really executing the best way possible, and it's simply got to do with because we can always, get a better price. We can always have a better stop. We can always get more size in. Okay, we can always get our timing even better. So that's the reason why we focus so much attention on our execution methodology. Okay, because we can always improve. Now, the reason this is imperative, and again, it comes down to percentages. Very simply put, if we increase our efficiency of execution by, let's say, a menial number like 10%, just simply by viewing how we're executing, and we increase it by 10%. Let's say you have £100,000 year. Okay, in theory you should be increasing your profits by 10%. Okay, now a 10% increase in profits, most of you would say if that was a normal business or that was any kind of a venture, the 10% return on your investment, which is i.e. working on this template, working on developing better execution methodology, you would all agree that this is something you would definitely invest in. Okay, so that's the crux of it. That's why we focus on the execution methodology. Now, again, we're going to start off with the two subsections, both money management and the application side. Under the money management, we're going to focus firstly on, obviously, passive or aggressive. So in this section, all you want to talk about now is that point from you've identified the timing, the market has said to you, bang, it's time for you to be long or short. This is now everything from that point that you click to the point that you get out of the trade. Okay, so the first thing, was your execution methodology passive or aggressive? In other words, on this strategy, do you have to be aggressive in nature, okay, or do you have to be passive? Now, what you're going to find with this is a sort of a double-edged sword, because most of the strategies you'll see predominantly they focus on more passive type approaches. We sort of use signals like absorption, like volatility shifts. So we allow ourselves more passive entries, but sometimes within the same strategy, you're going to have to be a little more aggressive. Okay, so there's, again, like I said, there's no wrong or right. It's important though that you highlight, was, on that execution, was I passive or was I aggressive? Okay, what was the result of you being passive and aggressive? If you were passive, did you miss out on prices? If you were aggressive, could you have got a better price? Those are the kind of things you want to spend time thinking about. Okay, then obviously, in terms of the risk stop placement, again, where did you put your stop? Where was the ideal place to put a stop? Now, what you're going to note over the next 10 strategies is I'm going to give you ideas of where stops should go. Okay, as a cardinal rule, there is no such thing as the right place to put a stop. Okay, please note that. There's, too many people have this understanding that a stop has to go here or there. It doesn't. Okay, a stop goes where a strategy has become invalid. It's as simple as that. So if your strategy is a momentum breakout, we break out, come all the way back in and re-enter the range, guess what? You should be stopped out. Okay, there's no questions asked. There's no where should my stop be. It's as simple as when the strategy is invalid. In other words, it's no longer in play because of what the market's price is doing. your exit, you're gone, you're out. Okay, that's how stops should be managed. Now, obviously note, again, ask yourself the questions. Where was my stop? Was it too tight? Was it too loose? Okay, when you do have winners and you don't get hit on a stop, always ask yourself, could I have tightened that stop a little bit? Right, you always want to be trying to save that tick. Don't forget, one tick on a 10 lot, okay, is 100 euros, $100, whatever it might be. That's a lot of money, guys. You do that over a period of 100 or 1,000 trades over a year, we're talking about $1,000 to $10,000, okay, just by saving one tick. Again, it's the small increments. You know, this entire course is built up of little edges, little understandings, and it's those little edges that will ultimately give you the big edge, which is ultimately becoming a financial futures trader. Okay, now in terms of targets, again, there is no exact target for any one of the 10 trade strategies. I'm going to advise you. I'm going to kind of tell you where the pattern has kind of exhausted itself, or the pattern is potentially done, and I'm going to give you advice where potentially targets will go. But again, you have to work on this, because what I deem as a potential target might not be the same for you. Okay, and that's important, and that's why we work on it. And then obviously risk reward, again, I've put it there, not so much as it needs to be focused on, but I've put it there so that you can recognize when trade strategies are no longer becoming worth the risk. Okay, so again, by following a metric like risk reward, you're going to recognize if you're used to taking maybe 2-to-1 risk reward on a trade, and all of a sudden over the last couple of weeks, you've recognized this trade strategy is suddenly offering 4-to-1, or maybe it's offering less than 1-to-1. Okay, that's the kind of things you're going to pick up on, and that's when you as a trader have to be flexible and nimble to adjust yourself. Maybe change strategies, maybe change your approach. And that's the purpose of completing these money management metrics. Okay, then obviously, in terms of obviously the strategy, do note, we spoke about obviously a passive retest in terms of entry point on the absorption auction. So we wait for the pivots to break, and wait for a retest and enter. We had a relatively tight stop, as mentioned, just below, back inside the distribution. Obviously, we take profit when the market gives us that reason to exit. And like with every one of these strategies, with very limited risk, ultimately we've got really good risk-reward metrics. Okay, once you've focused on the money management side, you then move on to the application side. Okay, and this is crucial. Now, application is all about how do you execute. Okay, and this comes down to, again, a little bit more of the psychological aspect of execution, but the first thing you want to talk about is your timing. Okay, what you're going to find is you're going to battle with this concept of, should I be stubborn and wait for the exact price, or should I be willing to ultimately, you know, be more aggressive and preempt the trade strategy. Okay, sometimes it will pay to be aggressive, and sometimes it will pay to be exact. What I am going to say to you, play around with the two. Okay, don't take my word as gold. Make sure you're playing around with it to see what works better for you. Okay, some traders are better at naturally being more aggressive in execution. Some aren't as good. Okay, so work within your own confines of your own characteristics. That's how you're going to adopt these strategies in a much better way. Okay, do note, as a rule of thumb, when it comes to preempting, remember this. It is okay to preempt only if the preempting gives you very, very good risk reward. In other words, and we'll talk about this in one of the later strategies of breakouts, breakouts reward preempting. Why? Because the nature of the break will bring in a great deal of volatility. So we cannot afford to miss out on all that potential reward when we can take just a little bit of risk to be a part of that reward. Okay, so as a rule of thumb, if there's very good reward, don't be afraid to preempt, okay, because you're getting paid for that additional risk. Equally, in terms of, you know, targets, in terms of reward, remember, as a rule of thumb, the more a market moves in, you know, in the direction of your favor, okay, and you're going further and further on sides, the more you potentially have to lose. Okay, so that's a really important thing to understand, because the more you're going on sides, the bigger effectively your stop is becoming. Okay, and equally, the more you go on sides, the smaller the probability of further profit there is. And that's important to understand. Okay, so the further you go on side, don't forget, you can never go bankrupt taking profits, right? But you don't want to allow, you know, yourself to become greedy, to become too specific in target taking, that you ultimately start seeing your winners evaporate. Okay, in terms of leveraging then, we're going to talk a lot about this. This is just simply, can you get big? How can you get big? Can you put on some size? Where can you put on some size? Where can you get big? We will discuss leveraging a lot later on in one of the units and why it's so important. But for now, just know within the strategy, we're not interested in leveraging. Why? It skews the risk reward. So again, when you go through your strategies and you come to the section on leveraging, ask yourself, could I have got more size? Where could I have got more size on? And how could I have got more size on without taking on more risk? Okay, we finished every one of these every one of these template completions with the tip. Okay, again, these are my tips. They could be your tips. It's up to you. So the tip for the strategy, obviously, usually a calm before the initiative is taken. And we spoke about that. I showed you what that looks like. It's a little bit of absorption just before the break. And do note, volatility breeds volatility. Okay, what you would then do, this is not the end of the template, obviously. There's two more sections to the template. One is the accountability section. You write down how long it took. How long did it take you to complete this template? Reason being, obviously, you'll get better, you'll get quicker. It's also a way to motivate yourself to see it actually doesn't take that long and you're gaining quite a lot from the experience. Also, don't forget to sign off on it. Equally, don't forget to fill out which day it is that you're completing this on, simply so you can follow yourself building a habit, okay? Building habits, the first thing you need to believe is that it can be done within a very short space of time, and that's why we have that day count at the bottom of the template. Lastly, read the quote. Keep reading that quote. Keep reminding yourself why it is you're filling out this template, and remember, you are on a path to sustainable pattern recognition. Let's move on then to the following slide. So like I mentioned earlier on in the unit, every one of the trade strategies is going to include an additional reading, and for very good reason. These are books that, often I get people asking me, what books would I recommend people read? Now, I don't believe in necessarily reading trading-based books, simply because they tend to be very backdated pieces of information. So they don't really help in the modern day market. So for me, I far rather pay my attention to real thought-provoking type books, principle-based books, process type books that can help me become a more effective trading athlete. Now, the first book we're going to recommend, or I'm going to recommend, is Ray Dalio's new book, Principles. Okay, this was released, I think, in October, November 2017, so it's just come out. A little bit about Ray Dalio. Most of you should have heard of him. He is effectively the founder of Bridgewater, and it is one of the largest, if not the largest, hedge funds in the world. So again, there has been a number of videos you can go watch on YouTube, but you can go watch, you can also go read one of his documents about Principles. And Ray Dalio deals with all these concepts of doing things differently, trying new things to ultimately get the most effective outcomes. Now, this book is no different in terms of a summary. It's a real practical application book, hence I'm recommending it. In terms of the action, it's going to provoke your thought for a definite, but it's also going to make you want to start to implement actionable processes, and that's why I'm really excited to introduce this book to you. Now, some of the key highlights, I don't want to spoil it too much, but there is a 5-step process for getting what you want out of life from this book. Becoming open-minded and learning from your failures and weaknesses, a concept we're going to deal with a lot throughout all of these strategies. You're often going to hear me talk about how through me failing at certain strategies, ultimately I learned a new strategy. Then moving past your ego so that you can focus on the pursuit of your goals, as well as why having people around you is important for increasing probabilities. And lastly, the idea of meritocracy and the best ideas through disagreement. And this is a fascinating concept, because what it ultimately says is that through disagreement, the whole idea of brainstorming effectively is not as effective as people think, but rather disagreeing with people is the best way to ultimately get some of the best ideas. So definitely read this book, put it on your wish list, make sure you get this, and read it as soon as you can. All right, let's now finish off and talk about some of the drills for the rest of the unit. Okay, so at the end of every unit, we're going to have a live drill practice session. And basically this is for me to introduce the drill to you, give you an understanding of how to execute the drill, as well as the process thereafter. So it's simple. At the end of every unit, you are going to find a drill. I suggest you go watch the drill with key focus on the interaction and relative changes. Okay, so go through again the principles underlying the strategy, read through that first. Once you've read through that, watch through the entire drill session. Now, once you've watched through it, go and complete the template. Okay, that's so important. Before you go on to the narrated drill session, make sure you complete the template yourself. Okay, the reason is that you're going to learn a lot more through your mistakes, but more importantly, you're also going to remember those mistakes a lot better, rather than going straight to the guided tuition. Okay, once you've done that and you've completed the template, go and watch it with the guided tuition. Compare and adjust your template. Okay, so make the necessary changes. Remember, there is no right or wrong. Okay, add to your template where maybe you might not have thought of something. Okay, then I suggest you go back and watch the full practical examples utilized within the unit, and again, focus on some of the key principles and focus on obviously the identifiers within each one of the template sections. Okay, again, complete a second template. This is for your own good. Lots of practice will get you good at completing this template. And once you've done that and you have confidence in the strategy and in the principles underlying that strategy, move on to the next unit. All right, that now wraps up Unit 6, Strategy 1. And we're going to finish off with the quote, which is that success is the sum of small efforts, repeated day in and day out.
So welcome to this drill session. This is Strategy 1 Guided Tuition. So let's get straight into it then. Let's roll the tapes forward and let's talk through as we go through this entire video session. Now, the market we're looking at, this is the WTI oil, and in terms of the context, or what we can see is we have got ourselves some rotations here, some 5-minute rotations. In terms of obviously the type of footprint, it's a time-based footprint, and in terms of the context that we find ourselves, well, the first key standout is the very negative delta on the day. We can see that down below, minus 5,190 at current time. So we can see quite an aggressive short positioning in the market. And we can see that really over the course of the session, we can see the sellers have dominated for pretty much the entire session. Now, very important, as we can see as per the candlestick chart, we can see price is responding to that dominant price action from the sellers. In terms of the current footprint, just a quick note here. Do note the imbalance sitting in the middle there. Again, what we do tend to see in the strategy called accumulation and distribution, absorption and auctioning, we do tend to see these imbalances whilst we are forming that sideways price response. Now, to cast your mind back in terms of the strategy, the key elements of the strategy, or the two variations at least, is this sideways type price response, but what we're ultimately looking for in essence is some form of a darker shading at the extremes, and that's kind of what we can see already. If we start on this left rotation here, note the dark extreme shading. So what in essence we are seeing there is sellers come down to that price point, and they're selling, but they're being met by a buyer that's absorbing all of the potential liquidity being sold. Okay, so at the low there we have got a buyer taking all the liquidity. The market then bounces and we go to the extreme side, and the extreme sides we can see the same thing, darker shading. This time however, on the top side, it's the seller that's taking all of the liquidity. Now, one thing I will say, always look, and again, a lot of the time it might just be complete noise, but always look where the heavier liquidity is being taken. So what we can see at the low extreme here, note 600 lots by 223, 561 by 556, 616 by 445, 541 by 433. So we can see quite a lot of the volume being taken at this low relative to this high. Okay, so what we're seeing on the high here, whilst there is still a pickup in volume in the darker shade, what we're seeing is we're actually seeing a lot less overall volume at the extreme. And what that's telling us is that the sellers are being more aggressive at the low here and more intentional at the low versus what the buyers are being at the high. So always interpret the total amount of volume being transacted. Now, what is very interesting and what's important to note is we do have the inside candle. So we can see this is variation number 2 of the strategy. We've got this inside candle now. It's formed inside of the previous candle. Do note what we're seeing at the extremes. Okay, 41 by 10, 0 by 30, 0 by 17. Okay, so this is telling us there is a real reluctance to initiate above this price point 16. Okay, we can see it not just once, not just twice, but now a third time buyers are not willing to initiate above price point 56.16. Okay, the same can sort of be said for the downside. We can see sellers did not want to initiate below this 56.01. Why? Because we can see only 43 contracts traded there. On 56.05, 92 by 46, and now again at the 06s, 70 by 0. So there's a real reluctance at the extreme points to be initiating. Okay, and what we're seeing at the extreme points is actually passive responsive liquidity being utilized. So yeah, we can see the buyers utilizing the sellers, and at the high we can see obviously the sellers utilizing the buying being provided. Okay, so that's where we are. That kind of brings it all into context. Now, with the strategy, so important. Okay, obviously we spoke about that signal, that clue when the market is about to break. So we're looking for that. We're looking for something that shifts, something that relatively changes, and that market kicks it up a gear. Okay. So what we're doing is we're looking now for the clue. We're looking for something that tells us that, you know, the nature of the market has shifted, and we've seen quite an aggressive change in the dynamics of the market. So that's what we're trying to keep our eye out for now, is some sort of a shift that gives us that clue. Now, keep in mind, obviously, one of those clues could be the break on either side of this, i.e. suddenly we see initiative above 16s or we see initiative below 06s. Equally, we could be looking for some seriously aggressive absorption on the extreme. So instead of the sellers taking all the buying at the high, we suddenly start to see the buyers absorbing at the high and vice versa, sellers absorbing at the low. That could be a second potential clue. A third potential clue could be a sudden shift in the price dynamics. Okay, so those are the kinds of clues we're looking out for. Now, do bear in mind, obviously, we always want to potentially go with the trend in terms of context. We've observed the trend is to the downside. We can see that with the cumulative delta. And note we can see relatively subdued volume at the moment. Obviously, we had the 10,000 rotation, and then we had 5,000 and 3,000 rotation. So let's have a look now. Let's talk this through. So we can see markets come back down again towards that 06 area where it will not initiate below. We can see again still relatively subdued price response, no real shift in the dynamics, but this is now obviously the fourth rotation within the previous three rotations. So we can see this elastic is coiling and coiling and coiling quite aggressively, and that's the real key. Okay. Okay, so suddenly there, note a little bit of an imbalance there. Okay, I'm just going to pause that slowly. Note the imbalance, so we can see obviously markets come back down. Suddenly we've obviously seen a seller hit into the 8s and quite a thinning out of trade. Now what we want to see if this is going to follow through. Okay, this is the first time we've seen this. We've seen a little bit of a shift in the dynamic, and note straight away 122 at the 6s. Note the sellers are now becoming more intentional at that price where they would not become intentional previously. We can see 136 traded. At the same time, we can see someone buying, but what happens? We see the selling, and that's our signal right there. We could see our sellers stepping it up, becoming more intentional at those 6s, willing to be initiating at that low. We're now looking for an entry point where that seller stepped in 05, 06. We're trying to offer the 6s here, trying to get filled. We can see 3 contracts traded, and there we should be filled now. Another 50 trades at 06. Our stop simply goes above the 11s, above the rotation. Obviously, we have to protect ourselves in case this fails. But ultimately now, note where the absorption is taking place. Notice where the market's holding. Okay, it's come back up to those 6s and 7s where we saw that shift in dynamic, and the market is now holding. Okay, note the absorption from the sellers. So we can see sellers stepping it up here, holding this price point, and bang, 6s trade, 5s trade, quite a bit of volume going through. Now, if we look at the delta, note the delta shift. Okay, minus 550. The last time we had quite an aggressive shift in the delta was the downward rotation before settling into sideways mode. So we really can see those sellers now stepping it up, really making an initiative move here, looking for a potential distribution or continuation in the direction of the break. Okay, so this is obviously our this is now the move that we are looking for, and ultimately okay, so again we come back up to those 6s, 7s, and we can see the market holding, and again trying out those 7s, 8s, 9s. So really testing our stop, but we've got to stick to that stop now. We can see that the sellers are happy to get hit on any kind of buying here. And again, we go 10 offered down to 9, down to 8, 7 and 6, and 5 and 4. and the market starts to pick up again where it left off. Note the delta now the most negative it's been on this rotation. We can see the delta at the bottom, also the most negative on the day, and bang, note the imbalances. Okay, lots of zeros going through, a bit of stops going through, one order stopping down. We can see the aggressive nature of the price response also shifting. Cumulative delta negative 7,400, nice big fat imbalance or low volume area, all the way from 05s down to 96s, and we can see a little bit of liquidity being provided at the low here. And again, this is normal. Okay, you're always going to find pockets of liquidity being provided. The question is how much more selling has to be done. Okay, if there's more selling to be done, we will obviously continue in the direction of the break. Now note the volume. Okay, a very, very big shift in volume. That's why it's gone dark blue in terms of the volume traded. We can also see that delta going very, very dark red. So really aggressive intent coming in from the sellers. They have taken the initiative and the break has occurred. Okay, so just to recap in terms of that entry point, okay, it wasn't as aggressive an entry point or a signal as you can get. All right, you can get far more aggressive ones. However, we were aware of it. We observed the nature and dynamic of the market. We observed the context of the market. We saw the inside candles forming, and we know it's one of our variations. We then, finally got an entry around that sevens. 5607 with a stop at 5612, good 5-tick stop. In terms of target, okay, we're still in this, right? We remain in this until the market gives us a reason to get out. Now, obviously, we can see that that low volume area and that imbalance area. So long as this holds, we will remain in the trade. We will talk about that trade strategy later on in the session. Okay, guys, hope you enjoyed that. That is then the first of our drill sessions.